If you want to learn how to invest in the stock market, you've come to the right video. Maybe you've come from seeing all of this news about GameStop dramatically rising in price, or maybe you're just not sure where to start. In this video, I'm going to show you an extremely reliable process that can help grow your money over 10 times. It's called dollar cost averaging, and the point of it is to invest a consistent amount each month. Whether you're 13, 30, or 50, this works for any age, and this process only takes a few minutes of your time each month. The strategy that we'll be using, called dollar cost averaging, is a form of passive investing. Passive investing is investing based on time. You're going to sell at a certain time. You could be retiring, or you might need to put a down payment on a house, so you'll sell some of your stocks and equities. The alternative form of investment is called active investing or trading. This is what you see a lot more in the media, on social media, on the news, and a lot of people portray it as an easy way to make it rich. The truth is, trading is very hard, and most people will probably not be making money, especially first-time investors. Passively investing may seem boring, but when you look at the amount of money that you can make off of passive investing, then it gets a little more interesting. For example, one of the most common investments is buying and holding into an S&P 500 fund, which has averaged a yearly return of about 10% since the 1920s. The S&P 500 is a collection of about 500 top US stocks and is often referred to as the market. So when someone says they beat the market for the year, that means that they beat the returns of the S&P 500. So imagine that you put in $100 a month into buying an S&P 500 fund, which is doable for most people, for the next 40 years. That means that you've put in $48,000 of your own money, and assuming that a 10% yearly rate still holds, you will have grown that investment to over $630,000. Okay, so what is the first step in dollar cost averaging? Well, you'll need an account with a stockbroker in order to actually invest. These include companies like Robinhood, TD Ameritrade, Charles Schwab, Fidelity, and a lot more. For absolute beginners, if you have very little understanding of the market, if you've never really bought stocks before, I would highly recommend starting out on a user-friendly broker like Robinhood. Robinhood isn't the greatest due to some controversy on how its trades are handled, as well as its cryptocurrency system, but it has one of the most intuitive and video game-esque UIs that make it an easy way to learn the market. What I would recommend doing is to start on Robinhood, learn the market a little, buy, sell some stocks, and then move to a more fleshed out broker. If you're unsure on which one to choose after moving out from Robinhood, I will leave a link to a guide in the description below. This includes both US, Canadian, and European stockbrokers. You can actually get a free stock on Robinhood by using my referral link in the description below. It's at no extra cost to you, and we both get a free stock, meaning that you have a chance at getting a company like Apple or Microsoft. Additionally, you might want to look for a broker that offers fractional shares. So for example, if Apple is trading at $100 and I have $150, I can actually buy 1.5 shares of Apple. This is helpful as I can invest all of the money into stocks instead of waiting to buy another share. You do have to be 18 in order to make an account under any stockbroker in your name. So if you're under 18, you can either get your parents to sign up for you, or you can sign up for a custodial account under their name. Unfortunately, Robinhood does not offer custodial accounts, so you'll have to look for a broker that does allow for custodial accounts. If you are going to look for a broker, then I would highly recommend looking for one that offers fractional shares, as you probably won't be depositing large amounts of money at a time. You can also choose to create a retirement account if you don't want to pay taxes annually. You can choose between a Roth IRA or individual retirement account or a traditional IRA. The difference between the two is that the Roth IRA is not taxed while the money grows and is not taxed when you take the money out, and a traditional IRA is taxed at your current tax bracket when you take the money out, but you get current year tax benefits every year that you have money in the account. Once you've made your account, you'll need to link your bank account and deposit some money in. Since we're doing dollar cost averaging, we're going to be depositing a consistent amount each month, so figure out whatever that is. If you're unsure on which value to choose, I would start with $100. So whenever your paycheck comes in, just put $100 into this account. If you can choose to deposit more, but make sure it is a consistent amount that you know you'll be able to deposit every single month. The key to this process is consistency and time. Remember, $100 a month for 40 years means that you can grow $48,000 into over $630,000. So start by depositing whatever that amount is. I'm just going to start with a very small amount just for demonstration purposes, and we're going to divide our money equally across 3 different ETFs, or exchange traded funds. ETFs are like a collection of securities that you can invest in, and so it offers a good way to diversify without having to buy each stock individually. 3 types of ETFs that we want to spread our money across are a US total stock market ETF, an international stock market ETF, and a US large cap ETF. The goal of this method is to provide both opportunity for growth and also for some protection as well. The US large cap ETF, which holds very large companies, is going to provide us with a good amount of growth potential, whereas the international stock market and the US total stock market ETFs are going to provide more protection for our portfolio. Alright, so for a US total stock market ETF, I would recommend VTI, or the Vanguard Total Stock Market ETF. This tracks about 98% of the total US stock market and provides a very wide exposure to a lot of different stocks. I'm going to go ahead and put 1/3 of my money into VTI right now. So I'm going to type into the stock ticker in the search bar, change this to invest in dollars, and then put in the amount I'm going to invest. Alright, next for an international market ETF, I would recommend VWO, or the Vanguard FTSE Emerging Markets ETF. This is a non-US international stock ETF and provides a wide exposure to a lot of international stocks. I'm going to go ahead and type in the ticker at the top here. Lastly, for a US large cap ETF, here you have 2 options, the QQQ or the VOO. The main difference between the two is that the QQQ holds a lot more tech stocks, whereas the VOO does not. So the QQQ is definitely more volatile than the VOO, but has also averaged higher returns in the past decade. So if you want to reduce risk, I would recommend the VOO, but I'm going to go ahead and put the last 1/3 of my money into QQQ. Alright, and that's it. We've put in 1 month's payment into investments. So what do we do from here? Well, obviously each 3 of these ETFs are going to grow at different rates. So when next month comes around, when you're ready to put in another $100, $200, $300, we're going to have to do a little portfolio balancing. So instead of splitting the money equally across each of these 3 ETFs, we're actually going to make it so that each investment has the same amount of money. For example, say investment A grows to $10, investment B grows to $15, and investment C grows to $25, and I have $100 to put in. Well, I would put $15 into the first one to make it $25. I would put $10 into the second one in order to make it $25. So now all 3 have the same amount of money in it. And now I can split my money equally. So I have $75 remaining, which means I would put $25 into each ETF. Some things to remember about this process is that the key to this process is consistency and time. You just need to buy a consistent amount each month and hold it. Remember, the biggest investors did not make their gains overnight. They made solid fundamental plays over long periods of time. Don't get concerned about your gains or losses in the short term. Look at the long-term graph. Remember, even if you bought before the biggest crashes in market history, you would still be making money. Alright, and that's how you can start growing your money through dollar cost averaging. It only takes a few minutes of your time each month, and it's a fairly simple process to do for anyone. If you enjoyed this video, leave a like, subscribe for more investing and personal finance content. Remember, you are responsible for any financial decisions that you make. All information on this channel is for informational purposes only.